Hello, in this lecture we're going to talk about production and cost analysis. We're going to take some of our economic terms, we're going to apply them to decision making within an organization, managerial accounting type of decisions. We have our quote we'll start off with from Peter Drucker, who is a managerial accounting consultant, and his quote is, "Production is not the application of tools to materials, but logic to work." And if we break that down, I think he could mean something like, the process of production isn't just taking the tools and applying them to one particular process. It does take more than that, in that we need some logical thinking, we need some reasoning, and in order to do logical thinking and reasoning to come up with the best decisions, we're going to take some systematic approaches to try to figure out what the best decisions are. So that's how we'll take a look at some of those techniques in economics applied to managerial decision making. So explain the role of the firm in economic analysis. Describe the production process in the short run. Calculate fixed cost, variable cost, marginal cost, total cost, average variable cost, and average total costs. We'll distinguish the various cost curves and describe the relationship among them. All right, so we'll start off with the role of the firm. All right, so in the supply process, people offer the factors of production such as land, labor, and capital to the market. So the individuals, the people, the households are the ones that actually offer the factors of production. And of course, then what happens is the firm transform the factors of goods and services to consumption. So the individuals are the ones providing the factors of production. The firm is going to be the one that's going to take those factors of production and produce something from them. Do want to point out that when we talk about the factors of production, that we're not just talking about the raw materials. It's easy to think that when we see the end product, that what something is made of is what it is. But notice that there's a lot of labor and a lot of other capital in there other than just the raw materials. And when we think about how much something costs or the value of something, much of the value, majority of the value, a lot of the time, is not the raw material in it. It's the conversion cost, the thing that converted it to the end product, and that includes the labor and other types of capital. So production is the transformation of factors into goods. So ultimately, all supply comes from individuals because they control the factors of production. So that means that individuals do have a lot of control in the market in that way. They're also going to have a lot of control on the other side because they're, of course, going to be the consumers of much of the production process, the amounts produced. Firms maximize profit. So how do firms maximize profit? The goal of a firm is to maximize profit. So clearly, firms may have other goals, and obviously their mission statement is going to state what their mission is. However, part of that goal is to maximize profit. And if they achieve whatever their mission statement is, meaning they provide any good or service that people want most of the time, then the result of that will be profits. If the firm is not making profits, then it's not likely that they are producing something that is desirable and or they're not producing it well, because the result of that would be maximizing of profits. So what is a profit? How do we calculate it? We take the total revenue less the total costs. So obviously profit's going to be a pretty simple calculation. We're going to take the earnings that we're making on the earnings minus the costs it took in order to generate the earnings. That's going to be our profit. So for economists, total cost is explicit payments to the factors of production plus the opportunity cost of the factors of production by the owner of the firm. So when we think about an economic cost, it's going to differ a bit from the financial statement. So when we think about accounting costs and we look at the financial statements to get those, it usually is going to say, okay, here's how much we sell it for, here's how much it costs, here's the gross profit of the transaction. But when we think about economic costs, we have to realize that when we look at the financial statement, that is taking into account certain costs. It's not taking into account some other costs that we need to add in there when we're making decisions, especially decisions that are on a larger scale, so managerial type of decisions on a bigger scale. The example that's often used in textbooks is going to be that if we're a student going to school, then we might think of the cost of going to school, and we might try to compare it with the future revenue. We might try to say the future revenue is going to be so much after we get employment over so many years, and compare that to the cost of tuition and payment and whatnot. That would be similar to like an economic cost. If we wanted to make the decision that we really should factor in the opportunity cost. And that opportunity cost includes what we could have done with our time if we were not going to school, which means, and that could be something like going to the beach or something like that. We'd have to somehow figure out what that opportunity cost was and factor that in. But it could also be something like getting another job and working during those time periods, whether you were going to school, and factor in the amount of money and revenue that was lost during that time period. For economists, the total revenue is the amount a firm receives for selling its products or service, plus any increase in the value of the assets owned by the firm. So we have the same kind of analysis when we think of revenue. We have to think of the revenue that's on the books, basically the accounting revenue, and we also have to include any other revenue that might be involved. Now, when we think about practice problems, usually the opportunity cost is going to come into play a lot, probably a lot more often than we're going to take into account other factors on the revenue side. But if we took like our example for a student going to school versus working, the opportunity cost being working or going to the beach during the time when they're at school, that's the cost, that's the opportunity cost. On the other side, it might be that if we just took a look at the revenue, how much added revenue would be there in the future due to work, less the cost of college, we might add in there on the revenue side. If we enjoy the job better, we might be going to school in order to get a job that we might enjoy better. And that would be part of something that should be in our decision-making process. It should be in the decision-making process in terms of the plus side, on the revenue side, and somehow be factored into our decision. So firms maximize profit. Economists and accountants measure profit differently. So accountants focus on explicit costs and revenue. Now, I don't think the distinction here is that cut and dry between accountants and economists, because if we think about it, of course, the decision makers in a firm are usually managerial accountants. They've been trained in managerial accounting, and managerial accounting takes into account a lot of these topics that are kind of economic topics. And these topics are going to include managerial decision making. So what the manager has to recognize when we make these decisions, when we're making decisions as a manager, usually bigger term, longer term decisions, we need to recognize that the accounting books take into account what the accounting books take into. That's how they're set up. When we make a longer term decision, we need to put into account these other factors. And these other factors are things that are commonly overlooked. We need to figure out what is overlooked when these decision makings are made, and where our logic and reasoning sometimes goes off, and where mistakes can then be made. And one of those, of course, is the opportunity cost. So the accounting text, we're going to have how much we're selling it for minus how much it costs. When we think about the revenue in terms of an economist or managerial accountant, the decision maker, focus on both explicit and implicit costs and revenue. So for costs, this is again another one of those costs that are going to be implicit, not in the books, not on the books of accounting, is of course the opportunity cost. And we same kind of idea for the revenue side. We got these other types of things that should be in our decision making that's not on the explicit numbers in terms of the accounting record, the financial accounting record. So the production process can be divided into long run and short run. So when we think about the short run, a firm is constrained in regard to what production decisions it can make. Some inputs are fixed. So when we think about short run decision making, we can break our costs out into fixed costs and variable costs. So variable costs will change with production, and we usually have control over those. Fixed costs, on the other hand, we don't normally have control in the short run. A fixed cost classically being like the rent. The rent is what the rent is. If we have a 2-year contract on the rent and we don't want to pay the rent, or we want to make some other decision, we're kind of locked into the rent. We can't really do anything about it. Therefore, when we make decisions, we should really take the rent out of the decision making, because we can't do anything about it. It is what it is. So what can we do stuff about? The variable costs most of the time. In the long run, a firm chooses from all possible production techniques. All inputs are variable. If we think of the long run, it's all variable, because, I mean, obviously, if we think about that same rent example, well, it is variable at some point. I mean, if we think 2 years out after the lease is due, then we can do whatever we want at that point. So in the long run, we're going to have different decision-making processes and techniques than in the short run. And this, of course, is important because we need to apply different processes and techniques in the short run to the long run. We need to understand when we're taking into account the short run, if certain things come up and we're trying to make decisions, how should we allocate those decisions based on the fact that we have control over some costs, variable costs, and no control over other costs, such as fixed costs? How can we make longer term decisions? And we need to realize that at some point in time, these costs are now variable. We do have the flexibility. And note, even when you think about managerial jobs, many managers are on the short run side of things, meaning they're making the day-to-day from week to week to month type decisions. And there's going to be some managers that are in the long run type of things. And some are going to be in both. And we're going to have to decide. We need to understand that, some people are good at this type of decision-making process, some are good at this type of decision-making process, and we need to have a toolkit, or at least have some understanding of the differences between the decision-making processes between those two factors. So the term long run and short run do not necessarily refer to specific time periods, but to the flexibility the firm has in changing its inputs. So it's not like the short run, we're going to say that's 1 year to 5 years, or we're going to say the long run's 10 years. No, what we're saying here is that at some short run purpose, depending on the firm, and of course what type of firm there are and who they are, so it's going to vary a lot from firm to firm, we're going to have different costs that are variable and fixed. And depending on the firm, there's going to be more leeway. Now, when are the costs going to go from fixed to variable? Of course, that depends on the firm. But at some point in time, they will, and we need to consider that on a company, firm by firm basis.